Good morning, everyone. We are so honored to have you with us this morning on this Thursday morning, getting towards the end of April. It's so fantastic that you would take time out of your busy day to join us today for our Shoemaker Chamber University. We've got two top-notch professionals with us today that are going to help walk us through and give us a layman's overview and how to regarding the employee retention tax credit. We'll go ahead and wait just a few more seconds to make sure that we've got everybody in, and then I'll go ahead and introduce our speakers today. Hope everyone is having a great day. All right, Kelly, are we ready to roll?
Yes, everyone has logged in.
Fantastic. Well, good morning, everyone. It gives me great pleasure to welcome you to Shoemaker Chamber University today on April 29th. You are here to learn about the Employee Retention Tax Credit, and we have two just stellar professionals from Carr, Riggs, and Ingram, CPAs and advisors, who are going to help walk us through this. I'd like to start off by introducing my colleague and my friend, Christy Cardillo. Christy joined Carr CRI in 2007, and she has over 20 years of experience in both public and private sector companies, along with international business, and also specializing in accounting expertise for nonprofit organizations, small business owners, physicians, manufacturing, and high net worth individuals. Her background she also has a background in human resources that allows her to consult with clients on personnel management, and fulfills quite a number of local leadership roles. I know I serve with Christy on the Career Source board. She does a phenomenal job as chairman of that board. One other highlight, she was also named a 2019 Top 25 Opportunity Zone Influencer by Opportunity Zone magazine, and has presented on other various tax topics, including the one that we're going to talk about today. She has a whole list of education licenses and certifications, and numerous professional associations that she belongs to. So we are so excited to hear from you today, Christy. I'd also like to introduce our second presenter, Anne Marie Sale. Anne has more than 15 years experience providing tax compliance and consulting services to business and owners. Handles a wide range of tax matters for CRI clients with C and S corporations, LLCs, individuals, estate, and gift tax areas, as well as a whole host of additional industries. She provides CRA clients with a personal and unparalleled experience in handling their estate and trust planning, as well as international tax issues. I do want to give a shout out because she is a Florida State graduate, and I've got a daughter there right now. So I'm very, very excited to hear from you as well, Anne. So I'm going to turn it over to you two ladies and help us understand what this is about and how this employee retention tax credit can help our businesses.
Absolutely. Thank you, Heather. I didn't realize you were going to go into all of that. So Anne and I actually have some introductory slides of ourselves that are kind of more fun than the pedigree. So this is Anne's background. She already mentioned that she graduated from FSU. She is very involved in high intensity interval training classes. She's traveling for soccer and sailing regattas. Maybe not so much right now, but loves to do that. And she has an English Cocker Spaniel. And what's your dog's name?
Molly.
Molly. Okay. So this is Anne and I trying to make sure you guys know that accounting is fun and we are fun people. So, and this is a little bit about me. My master's is from UT of Texas, and my undergrad is UF. That's why I like watching Gator football. And I enjoy traveling around the United States. I'm looking forward to being able to do more of that. And I have one dog. We think she's a long-haired Chihuahua, and her name is Bella. She's a little terror in the neighborhood. So without any further ado, I'm going to turn it over to start to Anne.
Thank you. Thank you so much. So I am still traveling for travel soccer every weekend in the middle of busy season, believe it or not. I'm not sure the firm would be too happy, but we're working hard. And part of working hard is understanding this ERC. We call it ERTC, ERC, retention credit. The idea is you can get a credit for paying people through COVID. So today we're going to go through what is it, who's eligible, what wages qualify, why we're talking about this for 2020 and 2021, how do you apply, and what are the advantages, you know, kind of what has evolved since COVID started a year ago with respect to this credit. So first of all, what is it? It is a credit. It is money in your pocket to provide liquidity for continuing to pay your people. Sometimes I say after the storm, and the reason I say after the storm, I'm in the panhandle of Florida, and we know about this retention credit related to hurricanes. And so we were hit by a hurricane. So in 2018, we were doing retention credit for hurricanes. Well, you know, the pandemic might seem like a storm as well, but the idea is to keep paying people through the pandemic. And so if you are an employer and you meet these rules that we're talking about today, the big kind of benefit to you is money in your pocket for continuing to pay people through the pandemic. You may have heard of PPP. PPP is a loan that can be a grant that provides you the ability to get money to continue to pay people. This goes hand in hand with PPP in the sense that you're getting money from the federal government to pay your people. It's just not done through a bank. So to get the credit, you have to have either, and underlined there is either, a full or partial shutdown due to a government order. We'll go over what that means. This is not just I decided to close because I couldn't get people to come to work, or I decided to close because business was down. You know, it is purely for purposes of the government order by governor, president. A lot of these orders came out in last March. The other option to get this benefit would be to have a decline in gross receipts. A decline in gross receipts, we'll go over what the rules are and how you qualify in detail. But I want to tell you kind of the answer, the whammy, the understand why this is so big. It is in 2021, $7,000 up to $7,000 per employee per quarter. So you're talking $28,000 per employee for 2021. These numbers can be a lot bigger than PPP. And you might ask, this has been around since last March, but nobody really talked about it. You know, we talk about in CRI, one of our other partners kind of was in charge of PPP, and I was, you know, picked to write about retention credit. Well, nobody liked mine. Nobody did mine. Everybody picked PPP. But as you can see here, on December 27th, you know, after it was passed in March, they changed the rules on us. They said, oh, if you got PPP, which was probably better in the sense that it's tax deductible, we're going to allow you to now go get the retention credit in addition to PPP if you follow certain rules. So before, my other partner was a lot more popular. He got all, you know, everybody went out and got PPP and everybody ignored retention credit. Well, you know, then I came to town and they allowed me to be more popular. And so I would say this is just as popular, if not bigger, than retention or than PPP. And you need to be educated on what to do, when to be patient, when to go after it, because they play together, but not, we call it playing in the sandbox. We have to make sure that they're playing together well in that sandbox, because if you go after PPP and apply for forgiveness without consulting with ERC, you might lose out on ERC. If you go after ERC and don't think about PPP, you might not get forgiveness. And so the idea is we want to absolutely get you forgiveness on PPP while also get you a retention credit. Let's go on to who is eligible. So I mentioned that it was either a full or partial shutdown or a significant decline in gross receipts. They do allow for tax-exempt organizations to qualify for this retention credit, so that was kind of a change recently. And so this is businesses that had a decline in gross receipts. I suspect that most people will fall under the bullet point 2, but certainly if you fall under bullet point 1, you don't have a decline, but you were forced to shut down in some way, you could still fall under this full or partial shutdown. There are numerous guidelines around this full or partial, and I would say seek guidance. If you're not meeting some of these gross receipts tests that we're going to go over, seek guidance to see if you fit in the bullet point 1, because that gets even more complex. So what is a significant decline in gross receipts? The definition changed. I mentioned that in December they allowed PPP and retention to go together. They also extended what was something in 2020 to go on into 2021. When I quoted earlier $28,000 per employee, I was quoting you the 2021 rules. The 2020 rules aren't quite as beautiful as 2021. In 2020, you have to have a 50% decline in gross receipts, and I'll go over that credit is a little bit lower. But so if in 2020 you had a decline in gross receipts of 50%, you could qualify for this payroll tax credit. I don't know if I've even mentioned that yet. This is a payroll tax credit. You don't get it from a bank. It applies on your payroll tax return. So for 2020, decline in gross receipts of 50%. If it's 2021, so in the current year, if you have decline of 20%, then you qualify to go after these credits. Healthcare expenses are included in the credit, so there's an allocation that you need to do if you have a plan for health insurance. Those qualify as well. Let's go to a little example here. It's kind of hard to read, and the way that it's worded is a bit confusing, but I want it for you to have for later if you want to actually put numbers on a piece of paper. But the idea is that an employer's gross receipts, and this is for 2020, so this is a 2020 example, same would apply for 2021. These same words could apply for 2021. But the idea is this gross receipts for this employer were 100,000, 190, and 230 for the Q1, 2, and 3 of 2020. And then, so you compare those gross receipts to the 2019, so the pandemic, the pre-pandemic gross receipts. And the idea is things were supposed to be normal in 19. And so in 19, gross receipts for this client were 210, 230, and 250. And when you run the numbers of these differences in these quarters, it's a quarter by quarter calculation. There is, this is what I don't like about this example. It says 48, 83, and 92. Well, we can do a little bit higher math, and it's really a decline of 52, 17, and 8. And so in this example, their 2020 gross receipts were down 52% in the first quarter. That's pandemic hit. They had to, pull back and shut down or not shut down, but they meet the gross receipts test because they have a decline in gross receipts of 52%. And so the idea is that they get a retention credit for their employees for 2020, and they qualify for both Q1 and Q2. The reason they qualify for both Q1 and Q2 is, I'm going to quote you the law. It says, it ends, so you get it when it's a decline of 50%. You could change that to 20% if it's 2021. But it ends with the first quarter that follows the quarter when the gross receipts are greater than 80% of the 2019 quarter. All that to say, it's very confusing, but the idea is if you meet it for a quarter, you're going to meet it for the second quarter. If you get one quarter, you get 2, period. You may get 3, you may get 4, but if you qualify for 1, you are automatically going to qualify for 2. Let's go to the next. So this is in words, kind of what I was trying to describe on that previous example. I want to tell you, gross receipts has many, 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 many definitions. And the definition for gross receipts is different for PPP than it is for ERC, retention credit. There's some Journal of Accountancy podcasts and discussion, but the gross receipts is defined as what is on your tax return. So, this is, if we're talking about book accounting, accrual accounting, cash accounting, tax accounting, you are looking for what is your method of accounting for your tax return. So you would want to have your quarterly financials and add up that top line revenue, not net income, gross income, the top line before expenses. What does that break down to quarterly, and make sure it matches your tax return before you're running these tests to see if you meet it. So you can see some special rules there to meet the gross receipts test. Let's just take this quarter, for example. We're sitting in the middle of April. Q1 just ended. If we wanted to see if we qualify for Q1 2021, we would look to Q1 2021 and compare it to Q1 2019, pre-pandemic to now. The asterisk is to say you can also choose to look to the prior quarter, 12/31/2020, to meet the test. So you can also look for Q1 2021, you can look to December of 2020 and compare to December of 19. And if you have that drop in gross receipts, you've met the test for Q1. So you have two options to determine if you meet this decline in gross receipts. All right. As far as how much is the credit, I want to make sure you understand that there are two calculations. This is another reason you may not have heard about this. Well, two reasons you may not have heard about this. The first was you could not do ERC and PPP together, so you now can. And then this is probably the second reason some of you may not have heard, is in 2020, like I said, it's only $5,000 per year, right? So $5,000 per employee per year. However, for 2021, it's $7,000 per employee per quarter. So you can get a max of $5,000 in 2020 per employee, but you can get a max of $28,000, 7,777 for 2021 if you meet the test for every single quarter. I think
Thank you, Ann. I'm going to go on to what are qualifying wages, because the terms in there where they calculate the maximum credit, and sometimes what they consider wages can get confusing. And there is an FTE, a head count that you have to look at. So and 2020, of course, is different than 2021. We have to make this fun. So in 2020, the rules were there was a cutoff, and your average number of full-time employees, whether you're considered a large employer or a small employer. And that cutoff for 2020 was you average more than 100 full-time employees during 2019. That you were considered a large employer. And what would qualify would be certain healthcare costs and the wages that were paid to employees that are not providing services because operations were suspended or due to declining receipts. The employers, they can only count wages up to the amount that the employee would have been paid for working an equivalent duration during the 30 days immediate preceding the period of economic hardship. Now, that's confusing when they say it. What that means is you can't pay them for vacation time. They have to actually be working. So it does make it kind of complicated in figuring out what is a qualifying wage when you're over that large employer cutoff, but it is completely doable. You just you have more rules that you have to follow. All right. And if you're average 100 or fewer FTEs during 2019, they're paid to employees during the period operations were suspended or the period of decline, regardless of whether or not the employees were providing services. So if you paid them for vacation, if you paid them for PTO time, that those wages would qualify. They're trying for the smaller employers to make the calculation simpler to do. The other thing that I've seen in an example, you know, if you, prior to the pandemic, if you had a rate of pay per hour, and then you go into the pandemic, the 2020 first, second, third quarter, and you cut their hours back, but you raise the rate of pay, they're going to make you use that lower rate, hourly rate. That's what that, for a large employer, that 30 days immediate preceding, they're comparing the compensation, what you were paying them per hour or per salary, or to keep it, they're trying to keep it even. Now, when you go into 2021, it's the same exact premise, except they change it from 100 full-time employees to 500. So they relaxed the rules some. And the other thing you have to take into consideration is when you, I know everybody's probably done PPP and calculated their full-time employees using the PPP rules. Well, for the ERC, you're using the 30 hours per week is a full-time employee. It's back to the rules you kind of use for healthcare to determine who's an FTE. They are not the same rules that you were using for the PPP calculation. So that gets a little confusing too. I would say calculate how many you have. If you're under the threshold, then you should be okay to go ahead and calculate your ERC. If you're over it, you need to do a little more research on what you can count as wages and what you cannot. So another item that I get a lot of questions on, and I think Ann probably gets a lot of questions on, is aggregation rules. So when you're figuring out these FTE counts, and when you're figuring out your gross receipts calculation for declining gross receipts, if you have multiple entities that you have common control over, same person owns 50% or more, or same entity owns 50% or more, and in the same singular line of business, you know, you have to push those entities together and aggregate them. It's kind of along the same lines of when you do 401k or health insurance, when you have to aggregate to figure out what you qualify for, where your threshold is. And that has become an issue with some clients with the gross receipts test, because in one entity, they may have gotten hit really hard, but in others, they weren't. So when you push them together to look at that gross receipts quarter over quarter, they don't have the 50% decline. So you do have to look at that, and it's not the easiest thing to figure out. So I have told clients, you know, when you get to that point that you're having to figure out the aggregation, you probably do need to reach out and ask for help, because it is complicated. It's based on common control rules that we use in accounting, especially in tax. And the other place where it gets a little complicated is when you have shared employees across entities. I have a few clients that they may have an employee who works in 3 different entities. Well, you only get one cap for that employee because it's aggregated. So it does make it a little more complicated to make the calculation. And then, you know, the IRS wouldn't be fun unless they did this. Once you do that aggregation, so you may have an employee that has wages across 3 entities, and you have to cap it across the 3 entities at 10,000. To claim it, you have to do it on the individual 941s for each entity. So then you got to prorate and allocate back to each entity what that employee is eligible for. So I say, if you get to that point, you need to ask for help. And you know, or have somebody else look at it and make sure that they agree with your calculation. So the steps to apply for the credit. First, you confirm if you have a shutdown or a declining gross receipts. If it's a shutdown, you can only use those wages during that shutdown period. So, you know, it is actually better time-wise to be able to say it's for the whole quarter. So I do try to look at that declining gross receipts first. You report the qualified wages on the Form 941. And you do have to watch those employee maximums, the 10,000. And there's a line where you actually report what the total wages are that are eligible for ERTC. You do have to monitor the limits on the numbers of employees working versus not working. And you also need to exclude the owners or anyone related. There's a code section on who's considered a related person because they aren't eligible. So you would have to back them out of your calculation. There's a couple lines down from that, and this is like the second or third page of the 941. There's a place where you have a refundable portion and a non-refundable portion of that tax credit. So the employer portion of Social Security is non-refundable. It's actually worksheet 1 that goes with the 941 where you would calculate it, and it'll have you figured out at the bottom of the worksheet what's refundable and what's not. And that portion of employer paid Social Security, you cannot get that refunded. You can claim an advance payment using Form 7200. So if you know that you're going to meet that revenue test and you calculate what you believe it to be, you can claim an advance payment. There are deadlines for doing that, and you do have to be considered a small employer. So under those headcount thresholds, if you've already passed filing your 941 deadline, you can go back and you can amend. You would file a Form 941X, and you file it for the quarters that you qualify. And I have been telling, I would say you want to attach your calculation to that amended return, because there is a box that says, please explain what you're amending. So you can explain it in the box, but it's just easier to say see attached and show them your schedule and how you're calculating it. And then, the IRS is coming out with FAQs. They've already sent out 2 different notices where they're giving a lot of good examples. So if you just Google IRS and go to look at those FAQs, you can probably find an example of a situation you may be in that will help. I mean, I learned from examples, right? And the examples might help you to figure out your situation and calculating the ERTC. So I put a link in here that goes to where those FAQs are. The American Rescue Act is what extended the 2021 from the first 2 quarters to allowing the 3rd and the 4th quarters of 2021, which is new. And they haven't sent out any FAQs on that, but I would kind of think that it's going to be the same as the 1st and the 2nd quarter. So I would just, make sure you're looking at those FAQs for certain rules or examples to help you in calculating it and applying it to your corporate structure or your situation. And then we have a schedule in here. Now, this schedule was a picture, so I couldn't change the 6/30/2021 date for that period because it does go out to the end of 2021. And we'll give you guys these slides. But I like this because it's a side-by-side and it's everything that we've just covered. And it kind of helps you to see what the difference is between the 2 years. And like Ann said before, ERC wasn't very popular in the very beginning because you couldn't do it with PPP. Now they've come out and said, okay, you can do the ERC with the PPP, you just can't use the same qualifying wages, which gets interesting, but it is completely doable to evaluate it and do that and be able to take both the PPP income in and be able to get the ERC tax credit. So I'm going to, and Ann already talked about the alternative comparable quarters. If you're a startup or you're new and you didn't have 2019, they do have some alternatives that you can use by using the prior quarter or using a 2020 first quarter to compare to 2021. So if you have a special situation, I would definitely go look at those FAQs to figure out if there is a different comparable quarter that you can use. Okay, so ERTC and the PPP. They are somewhat alike, but they are very different. They have different qualifying periods. The PPP has a 24 covered period, where ERTC is based on quarters and it's related to the shutdown. They have, the second draw for PPP had a gross receipts calculation that you did. That was if you had a 25% drop. We can't use the same percentages because that would just be too easy to keep up with. Where the ERTC has the 50% in 2020 and 20% in 2021. They do have different definitions of gross receipts. PPP will allow you to include net capital gains. So if you had a capital asset that you sold, that sales price less the cost of that sale, they will allow you to include that in gross receipts. Whereas in the ERTC, it is not included. And they do have different qualifying wages because of how ERTC, if you're over a certain FTE threshold, you can't include vacation, you can't include, PPP said you include all wages. So there are some differences and you need to pay attention to that when you're calculating your analysis, just to make sure you aren't kind of letting those PPP rules bleed into the ERTC. It can get confusing. So the same payroll costs, they can't be used for both. So some organizations, you have enough payroll costs because they push PPP out to 24 weeks to cover both of these, the ERTC and the PPP. Yeah, I like Ann's sandbox definition. They can't both play in the sandbox together. If you put down on your forgiveness application all of your payroll for that 24-week period, and you don't put any of your other costs on there, then you have to look at it and say, all of those payroll costs against my loan that I got forgiven, I have to use up to that loan amount. Then if there's any payroll that's above and beyond that, you can use them towards ERTC. There is a way, they did come out in the FAQs that they issued later in the first quarter, that there is a way to use the excess. There are a ton of examples in the FAQs of how to calculate that excess payroll cost on your forgiveness application. If you put too much payroll cost on there that it was more than the 60% that you needed, they are letting you use the additional as long as you had the other costs on that forgiveness application for the other 40%. I had some clients that, we're just going to put payroll on, we're not going to do the other costs because that was a lot to go pull and attach and add to it. Well, now when you do that, you have to look at those payroll costs and just take the difference before you can qualify for the ERTC to figure out the excess. So it is a little tricky, but there is wiggle room there. And then once you get past your covered period, all the wages beyond that covered period for PPP are eligible for the ERTC. So, and there are ordering rules. If you look at that worksheet 1 for the 941, you kind of see some of it come out. But so the ordering rules are wages get used for the FFRCA, those paid leave credits first. So if you've used any of those wages for those paid leave credits, you have to back those out first. Then you use the retention credit, then the PPP. Ann and I put this together before the FAQs came out. And we were telling everyone, go after that second draw of PPP. I still think that was the right thing to do. It just ensured that you got money before it ran out. And then you want to, do the analysis to layer that second draw PPP with your ERTC tax credits. It's nice that they have extended it out into the third and fourth quarter, because I think more people are going to be able, especially those businesses that have been hit really hard, they're going to be able to use that to help supplement some of the payroll. And then if you're going to go back to 2020, you do need to amend by filing Form 941X to take advantage. I have definitely told there are certain nonprofit entities that didn't qualify for PPP in the first draw. Well, in 2020, they added that when we got into the update for PPP. So that whole period in 2020, those entities didn't take any PPP. So I'm telling them they need to go back, and as long as they qualify for that drop in revenue, they need to go ahead and apply for those ERTC credits. So it's a lot of information. It's, you really have to start pulling your payroll information down with your PPP forgiveness application, backup information that you have, and comparing them and, asking yourself the questions. A lot of clients start going through the, calculations, and they'll figure out that they don't qualify because the revenue didn't drop. So you kind of do it a step at a time. And as long as you keep getting the green light that you still qualify, you just keep moving forward. But it isn't the easiest calculation, but it's not impossible. You just have to do it a step at a time. And it is quite a bit of money when you start adding it up, when you add up the number of employees that you have. So it is well worth the time figuring out if you qualify for it. So at this time, that's the end of our presentation. I have some, CRI firm facts that we'll send out in the PDF version and our values and how to connect with us. But at this time, if anybody has any questions, I think, Anne, unless you have anything else you want to add, or if you want to tell me I messed something up.
No, you did great. I just want to make sure people realize that on forgiveness round 1 or forgiveness round 2, ERC, and you said it, don't just go fill it out. Certainly you don't want to miss the forgiveness. You need to get that forgiven, but it's easy just to put payroll costs in there for forgiveness of PPP, but I would encourage you to go look and understand what those other qualifying costs are. 60% has to be payroll and the rest can be other qualifying costs. If you can fill up that bucket with those other qualifying costs, you can move on with that PPP forgiveness and then leave the rest for us to do ERC calculations. Just kind of know the facts of what you need to gather and pull to ensure you're getting that maximum forgiveness on PPP while also getting the maximum qualified wages on ERC.
Yeah, the other thing I think people sometimes forget with those other costs, when they came back through for the second draw, they did add a lot more to that. I mean, I think there's PPE in there, and if you had to mitigate and change some of your IT, there were quite a few additional things that got added that would help you qualify for forgiveness. So it's definitely worth a look before you finish filling out your forgiveness application. So do we have any questions?
Christy, I did have a question. A lot of our chamber members are small businesses. So would you advise that, they work with their accountant to navigate this? Or do you think this is, something that a small business owner should try to take on individually?
So, it depends on who is helping them internally. So I have some clients that they've just come to me and said, you have to figure this out for me. But I've had others that they have an internal accountant and, they may have them calculate it all and then have me review it. I've had some larger clients that said, we just want you to do it. It's just a matter of assessing your ability to have the knowledge to be able to calculate it. And also if you have the time, because it is a little time intensive putting it all together and doing the amended 941s. So, it's not a yes, no answer. It's you have to evaluate your capacity to be able to do it, hours wise and knowledge wise, and then make a decision. We're happy to do it any of those ways, however we can assist and help.
Typically, we become the quarterback trying to make sure the payroll company is talking to the accountant, is talking to the banker. We have to deal with the banker for PPP, your accountant internally to make sure we understand gross receipts, and then a payroll company. So it's not that we're trying to take away from a payroll company. We're just trying to support and guide that ship, because we can see all three aspects from accounting to payroll to banking, even if we're not doing any of that for you. I have a particular client that I was able to tell him he was getting $130,000. I do everything for him from payroll to accounting to tax to banking, because I have a relationship with his banker. So within an hour, we were able to kind of get him $130,000. That is not the case with all, because we don't always do quarterly financials for everyone. So it's just really that while we may not do your payroll, we got to make sure your payroll company, if it's a bigger payroll company, is aware and helping you tell them what they need to hear for those qualifying wages. So it's, we wouldn't go do the actual form. It's kind of like that Verizon commercial one time, I don't actually do it for you. I just, we would guide your payroll company with what they needed for qualifying wages to be able to take advantage.
No, Anne makes a really good point. The payroll companies don't see your gross revenue, and they don't see your PPP forgiveness application. So they're kind of blind doing your ERTC. So you really do have to communicate with them and make sure they understand how to split that pie up So, yeah, absolutely. Any other questions?
We did have a question in the chat, but I believe you've kind of, I believe you just covered it. Just how would this work if a company uses a PEO?
So I don't think we covered that. I mean, we kind of did. So there are quite a few FAQs out there about PEOs. The rules that are out there in that FAQ, it definitely says that the PEO does not keep the ERTC credit. It does get allocated out to those co-employers. I hope I'm using the right term. So you would have to work with your PEO to get the information to do the amended return. And I, to be perfectly honest, have not gone through all of those FAQs, but it is definitely something, because, you know, when you're using a PEO, you're co-employers and they're filing a 941 for all of the co-employers they're with. So you do have to work with them to get the information to be able to get the amended return done.
I think you still qualify and you still get it, and there are specific laundry list of rules to get you there.
Right, and you still have to go through the gross receipts as your own individual employer to qualify and to do all those things. It's just you have to coordinate how you apply for the credit with the PEO.
And is there a deadline to do this? Like how you know, is the clock ticking, or?
I don't know. Do you really think, I think, you know, it's a matter of being able to amend your 941, which there's a, you know, I personally, and I don't think this is totally a rule, but I don't like to go past the year end. Mostly because, you know, it's a tax credit, so it's not affecting people's W-2s in any way, but, you know, and this is just me who has to call the IRS all the time. I hate having them have to fix payroll once it goes into another period, like into another tax year, because it takes them longer to get it corrected and to deal with it. With this being a tax credit, you probably have more time. I mean, isn't it a 3-year statute in?
There's probably a 3-year statute. There's a catch-22 on this. I mean, they didn't tell us that we could take it with PPP on this until December 27th. So it automatically defaulted that you have to amend 2020 to get it if you weren't with it within a few days of year end. So it's expected that 2020 will be amended. And so that follows those 3-year statutes. That being said, I also, you know, in a day or two, your Q1 is due. I have pushed many clients off to say, look, you're in the middle of a PPP loan. You don't know how much your wages are. We don't even know what your gross receipts are. I am not about to go fill out a form to give you a $130,000 credit if we don't really know who's on square one. So the goal has been for most of my clients to get them above board and knowing where we are by Q2 so that we amend Q1 and get Q2 right the first time. The disadvantage is an amended quarterly does take longer to get the money, but with 130,000, and I say 130, that was the average client, what they got. With $130,000 on a line per quarter, we want to know we qualify, we know it's right, we don't want issues surrounding.
Well, the last thing you want, right, Ann, is to get an amended 941 stuck in the IRS.
Right.
And not moving forward. So you really do want to be particular about getting it right. The IRS is already overwhelmed and backed up. You know, and they're getting there, but I mean, to get things processed, it's taking much longer than it ever has. So, and if you get something that you don't have it quite right, they're going to push it to the side. I didn't see anything in the FAQs, somebody might correct me, that said there's a time limit on them on how long before they can process. There's certain things we file with them that they have 6 months to process it. But I have seen things happen in the last year that I've never seen before. You know, I had a Freedom of Information Act request that I put in that they literally have 30 days. There's a time limit by law for them, and they called me and told me there was no way that they would make that date. So I mean, I think all bets are off. That's why you really need to make sure you've got it all right, all documented, all the information is there so they can look at it, they can see it, it's really clear, they can follow it, and they can process it. Otherwise, it's going to get stuck and we won't be able to tell you how long before you can get it through the IRS.
Great.
How's that for a deadline?
Yeah. Well, wonderful, solid, informative information. I think the takeaway is that we need Carr, Riggs, and Ingram to help us. You guys are doing a great job, and this was really, really good. I really enjoyed. I learned quite a bit during the presentation. I hope all of you who joined us today, I hope you had some phenomenal takeaways as well. We did record this session, so if any of your coworkers or colleagues want to come back, Kelly can definitely share the link with you. Kelly, I'm going to turn it over to you for upcoming events, but I first just want to give a sincere thank you to Anne Marie and to Christy for your time this morning. We know it's tax season. You guys are up to your eyeballs, and so gracious and honored that you would spend time with us today sharing this really important information for our businesses. So thank you, and thank you to the firm CRI.
Thank you.
You're very welcome.
Okay, just wanted to share a few networking events that we do have coming up. Next Friday, we have our first Women at Work lunch at Art Ovation. Our guest speaker will be Jessica Muroff. She's the CEO for United Way Suncoast, and she's going to talk about how to get work-life balance. So I believe probably all of us can get some good tips from that. We do have a power hour lunch at Grillsmith on Wednesday, May 12th, and they have been selling out. So if that's something you'd like to register for, please register right away. And we have our first Chamber Connect of the year at the Sun and Fun RV Resort. They have a lot of fun things for us planned. That'll be Thursday, May 20th. And registration is now open for the Small Business Awards, June 25th, being held at the Hyatt. So go ahead and get registered for that. And that's all we have. And I'd like to personally thank Anne Marie and Christy also. Great, a lot of detail to this. So we do appreciate your time. Thank you, everyone. Have a great day.
Thank you.